2022 was a very volatile year in the markets. 2022 started off with great optimism. A lot of market participants were looking forward to a proper recovery from the past 2 years, which were impacted by the pandemic. We saw a proper rally towards the end of 2021 and into the beginning of 2022. Then Russia invaded Ukraine. Geopolitics worldwide intensified. Supply chains were incredibly impacted by the war, which together with a number of other factors, most of which were evident in the COVID years, caused inflation to skyrocket. Developed markets saw record high inflation. In fact, for a few months, we saw the US and UK inflation exceeds South Africa's inflation. Many market participants in developed markets had never dealt with the level of inflation over their careers. Central banks responded by hiking interest rates aggressively. Consumers started to feel the pain. Market participants started to worry about the possibility of a recession. This is where we are now. Will we have a global recession? Will we have certain developed countries going into recession and maybe others too? These are big questions for the year ahead. There are lots of opportunities to make money in the markets. You just have to look through the noise and find them. As they say, where there's a crisis, there's an opportunity. On this series of This Week in Markets, we will sift through the excess of market information and try to simplify it enough for the average person who is investing on easy equities or any other trading platform to understand. We have seen a number of platforms lately making it easy for everyone to trade, but there is a huge gap in the sense that you have all the tools, but the information is not packaged in a way that you can understand in order to effectively use those tools. We will try to distill market information to make it accessible and understandable for everyone. So, let us start with economic data coming out of South Africa this week. Stats SA announced the inflation rate for the month of December 2022, which declined for the second consecutive month. That is good news. First, because it gives us confidence that inflation is moving in the right direction. The South African Reserve Bank targets an inflation rate between 3% to 6%. The inflation rate has been above that since May 2022. This, in simple terms, means that when the inflation rate goes above the 3% to 6% range, the South African Reserve Bank will usually respond with increasing interest rates in order to bring the inflation rate back into their target range. In aggregate, between November 2021 and November 2022, the South African Reserve Bank raised interest rates by 3.5%, bringing the prime lending rate to 10.5%. The inflation rate in December declined slightly to 7.2% from 7.4% in November and 7.6% in October. Average annual inflation for 2022 was 6.9%, higher than the 4.5% recorded for 2021. The 2022 reading is the highest annual average rate since 2009, of which it was at 7.1%, which was the end of the global financial crisis. The South African Reserve Bank will sit on the 26th of January 2023 for their Monetary Policy Committee meeting, where a decision about interest rates will be made. An inflation rate that is decreasing gives us confidence that the aggressive rate hikes are going to end soon, and hope that the next interest rate hike will not be as high as the previous ones. So now this is a lot of information. Let's just try to simplify it. Think about how having high inflation and high interest rates at the same time affects you as an individual. First, groceries, then fuel, and all your normal household needs are increasing more than usual. Then you have your bond payments and your vehicle payments also increasing more than usual. Just think about that. At a time when a salary, or rather your salary, is staying the same, that means you have less disposable income. Having less disposable income means you don't buy as much stuff as you used to before. When consumers have less disposable income and have to decide what they want to buy and what they don't want to buy, the first items that go out of their shopping baskets are durable and discretionary items. So, for your personal investments, when you see that the average consumer is being squeezed, you want to stay away from cyclical companies. These companies sell goods and services that are in demand when the economy is doing well. They include restaurants, hotels, airlines, furniture, high-end clothing retailers, and automobile manufacturers. When people delay or stop buying anything durable, the revenues of these companies that produce such items or sell such items fall. This in turn puts pressure on their stock prices, which start to drop. In the event of a long downturn, some of these companies may even go out of business. So, if you look around and think that we are going for a recession, you would typically want to invest in bonds and more defensive or non-cyclical companies. These companies produce or sell goods and services we always need, including things like food, healthcare, pharmaceuticals, and other non-durable household goods. Sometimes tobacco and alcoholic beverage companies can be seen as non-cyclical because of the addiction factor they have. We will now go through economic data that gives us an indication of the general position that consumers find themselves in. But remember the key theme for today's episode. If the economy, and by extension the consumer, is doing well, we want to go into cyclicals. If not, we want to go into defensives. Stats SA also released retail sales for the month of November. For the year ended November 2022, retail trade sales rose a modest 0.4% with a month-on-month increase of 1.1%. The month of November was probably boosted by Black Friday sales. The 0.4% increase represented the first annual increase since August, when retail trade sales grew 2.1% year on year. Market participants expected retail sales growth to be significantly lower, so the positive surprise is indicative of a resilient consumer. However, the low year-on-year growth is quite low, so some concern is kind of creeping in there. Now, let us look at the global market. We also saw US retail sales data being announced on Wednesday. Monthly retail sales declined 1.1% for the month of December. Retail sales have decreased for 3 of the last 4 months. Another data point indicated that factory output declined 1.3% in December. The last quarter of 2022 was the weakest quarter for manufacturing since the onset of the pandemic. This data shows a consumer that is starting to feel the pressure from high inflation and high interest rates, and it also shows declining business investment, which raises concerns that the economy may be inching closer to a recession. This data, together with the inflation in the US slowing down in December to 6.5% on an annual basis, down from 7.1% in November, and a peak of 9.1% in June, might put the Fed on track to slow down the pace of the interest rate hikes. Again, this is good news. Another piece of data that gives you the picture of where the average US consumer finds themselves is that the saving rate is near record lows, while credit balances have increased. At the same time that we're seeing initial signs of an impending US recession, we saw application for US unemployment benefits unexpectedly fell this week, sliding to the lowest level since September. This data is available on a weekly basis, but if we look at the 4-week average, it also declined. This is evidence of a strong job market in the US. This is likely uncharacteristic for the time in the cycle where market participants would expect unemployment to start ticking up as companies start to feel the pressure and let go of some workers. The unemployment rate ended the year at 5-decade lows of 3.5%. This is the case even though we have seen high-profile firms in the finance, technology, and real estate sectors have announced thousands or tens of thousands of job cuts in recent months. The National Association of Home Builders Housing Market Index in the US increased to 35 in January of 2023 from 31 in December of 2022. Now let's look at the UK market. We won't dive deep into this one, but we also saw UK inflation and retail sales data. UK inflation seems to have peaked in November 2022. In December, the CPI, including owner-occupiers housing costs, slowed down slightly to 9.2% from 9.3% in November, marking the second consecutive slowdown in the inflation rate. Retail sales were also down 1% in December from November 2022. On an annual basis, sales volume were down by 5.8% compared with December 2021. The biggest fall for that month in records going back to 1997, and the 9th month in a row that they fell in annual terms. This is another data point that indicates the idea that the UK economy is showing signs of slowing down. The European Union also released inflation data. The euro area annual inflation rate was 9.2%, down from 10.1% in November. The European Union annual inflation was 10.4% in December 2022, down from 11.1% in November. Now, if you look at the chart, again, we are seeing that inflation has peaked in this region. Meanwhile, in Asia, China is finally reopening after unexpected lockdowns in 2022 as they implemented their zero-COVID policy. Market participants are expecting the reopening to unleash pent-up demand for commodities, consumer goods, and travel, which adds a layer of complications for the global economy because you have a number of economies slowing down while China is just getting started. China consumers have about 5.6 trillion yen, which equates to approximately 836 billion US dollars in excess savings that they built up during the pandemic. Sectors such as luxury goods are likely to benefit from this. Despite the higher COVID infection rates that come with the reopening and the government's decision to ease COVID restrictions, along with its effort to shore up the slumping real estate sector, will likely lift consumer confidence in China and help overseas commodity producers such as Brazil, Chile, and even South Africa if Transnet is able to deliver. Market participants are expecting GDP growth of 4.9% in 2023 after it slowed down to 3% in 2022. Prices for copper, considered a barometer of China's economy, have rallied on the news of the reopening. Many economies will be impacted by the reopening of China because of the magnitude of trades between the countries. Again, think about what this could mean for different sectors and how to position your investments. Think about the backdrop that we've described. We've got elevated level of inflation that have peaked and are now moderating. We've got elevated interest rates with central banks. Think about the magnitude of their next interest rate hike, one where many market participants are hoping that it is lower than what we have seen thus far. We've got the economy slowing down and the consumer showing signs of pressure. Amid all this, we've got China reopening. On the local front, we've got the highest level of load shedding that we have never seen in recent years. Sectors that would be most affected by that would be agriculture. Think about the several KFC outlets that were closed in December due to the lack of on-the-bone chicken. Load shedding affects mining and manufacturing as well. Now, against this backdrop, we prefer shares and ETFs that offer decent value, that would be trading at a discount to their historical price or relative to peers. Shares that are more defensive, as we described earlier on. We also prefer bonds like South African government bonds, which are the easiest way for a retail investor to get involved. Now, coming to South African local company news. On the 13th of January, MTN announced that MTN Ghana received a notice of assessment of a tax liability from the Ghanaian Revenue Authority, saying that MTN Ghana owed approximately $773 million because they underdeclared their revenue by approximately 30% after they did an audit for the period between 2014 to 2018. The assessment was withdrawn, allowing for a 21-day period for all parties to engage. MTN strongly disputes the accuracy and basis of the assessment. An independent review concluded that it was unable to support the conclusions reached by the Ghanaian Revenue Authority on the assessment. It is likely that the tax liability will not hold. Nevertheless, investors were spooked, and the share price closed Monday the 16th 4% lower. The share price has since recovered as investors were reassured. The share price ended the week 0.35% lower. The share price is up 6.9% year to date. On the other hand, SPAR has been seeing some allegations about fictitious and fraudulent loans, which led to the CEO and the chairman of the board stepping down. In addition to that, there have also been allegations of discrimination against some of their retailers. Regarding the loans, PwC has reported a reportable irregularity to EBA. The board and the independent auditors investigated the matter further and found that 3 loans totaling 11 million rands were taken from a willing lender. However, there was no real economic or commercial purpose, and these loans should not have taken place. These loans occurred 5 years ago, and SPAR says that they were isolated, and the reportable irregularity is no longer ongoing. They have also indicated that the allegations of discrimination are unfounded, but there are some areas of improvements that they are working on. The share price ended the week 4.25% lower since the announcement was made on the 19th. This is after it had climbed on the 17th and 18th. Despite all of this, the share is still up 16.3% year to date. This week we saw Woolworths reporting very good sales results for the 3 months ended December 2022. This led investors to believe that most retailers did well during the festive period. However, this was proven not to be true when Mr. Price reported lower sales results than most market participants expected. When deciding which retailers to invest in this economic backdrop, think about what we've said earlier on about cyclical versus non-cyclical businesses. Other retailers are expected to release their results within the next coming weeks. Richmond also reports lower than expected sales results for the 3 months ended December 2022. This was mostly because China experienced significant lockdowns. Other regions were doing well, however, a lockdown was experienced in the American region. Again, think about the fact that China is reopening and that the US consumer is starting to feel the pressure. However, this is luxury, and in a downturn, lower-end consumers usually experience the pinch most. This brings us to the end of our first episode of This Week in Markets. We are looking forward to what the upcoming week has for us. Feel free to like, comment, and subscribe below. I am Billy. All thanks to Zoe and the team. We'll catch you again next week.